In this session, I'm going to focus on the mechanics of the option markets, where I would primarily look at the different types of options which we have initially discussed also, a call option versus a put option, probably an understanding of American options versus European options. So we'll spend some time in terms of understanding the different types of options. And what do I mean by the positions? What are the different kinds of positions that are there in options, the long and the short positions? How do I typically interpret each of these positions with respect to the options? Then, what are all the various underlying assets on which the options are typically traded today? And what are the key elements that go as a part of the option, the specifications? What do I mean by the expiration date? What do I mean by the strike price? So the various specifications that are associated with the options, and more or less talking about just a brief idea into the trading activity associated with the options. And I would just touch base upon the commissions that are typically associated, the costs and the commissions that are associated with respect to option. And one more important point, as we have discussed even in futures, how margins are typically playing a role with respect to the option. So these are the different dimensions that I would like to cover, and towards the end I'll spend some time in terms of understanding the different applications of option. So where I would focus, just give you an overview of how warrants or probably employee stock options, ESOPs, convertible bond, they are also some kind of variants of the options themselves. So this is what is a typical thing that we are going to look at as a part of this particular session. All right. So to get started, the first thing I will be focusing on is an understanding of the different types of options. We know that there are two major types of options: one a call option and two put option. So whosoever has taken the call option, for that particular person, we are talking about right to buy. Whosoever has taken an option, he is having a right to buy an asset in future. If he wants, he can buy. It's a right. It's his right to buy the asset in future, whatever the date, within a particular date, and a price, which are typically decided upon today itself. Right on the day of entry into the option contract itself, these two are agreed upon. Whereas when we are talking about a put option, the person whosoever has taken the put option, he has the right to sell the asset. If he wants, he can sell the asset. If he does not want, he cannot. He can very well not sell the asset also. But if at all he wants to sell, the date as well as the price at which the selling can happen are decided at the time of entry into the contract itself. So here the person who has taken the option is called as the holder of the option, or we generally call as the buyer of the option, or sometimes position wise we call it as the long position in the call option. Whosoever has taken the option, whosoever has given this call option to this party, we call them as the seller of the option, or we call them as writer of the option, or we even call that particular position as the short position itself. Similarly, in case of put also, we have the same role. The holder or the buyer of the put option, he will have the right to sell, and the seller or the short of the put option is acting as per the buyer of the put itself. So probably if I try to make a grid kind of thing here, buy and sell, call and put. Probably instead of buy and sell, I could have put it as long and short. So if I look at a grid here, a long call position, it's right to buy an asset in future. And if at all this person wants to buy the short call position, it is mandatory to sell. If at all the call wants to buy, a long call wants to buy, short call position has to sell it. Similarly, when I take up a long put position, we are talking of right to sell the asset in future. And when this party wants to decided to sell it, the for a short put position, it is mandatory to buy that asset. So the short positions in the option, they are mandatory to they have the mandate or they have the obligation to act as per the decision of the long positions of the options, whether it is call or put. The date on which the buying or selling or the decision of the long position can take place is what we call as the exercise date or the expiry date or the maturity date. These are the various terms associated with it. The price at which the buying or selling can happen or the option to buy or sell takes place is what we generally call as either the exercise price or the strike price. The two common names associated with this price, the exercise price or the strike price. Now, one more dimension with respect to the types of option is generally the options can be American or European. So this is more to do with the expiration date. If the party can really, if the party who has taken the option can really decide about going ahead with the option or expiring it any time before the date. Let's say the expiration date is 20th August 2014 and today it is 1st August 2014. The party who has entered into this American option can decide on any of these days from 1st August to 20th August in terms of when he can exercise the option or when he can expire the option. That is what is the characteristic associated with an American option. But when we are talking of European option, the exercise can happen only on the expiration date. Anywhere before the expiration date, all these days from 1st August to 20th August, even though there is a possibility of exercising the option, this position cannot exercise that option. That is what is the behavior of European option, right? So that is one categorization of the options, looking at it as European versus American. Now let's spend some time in terms of understanding what happens as a part of the call option. So when we talk about a call option, the from a buyer or from a long position, I always talk in terms of position. From a long position, he has the right to buy the asset in future at a fixed price. Right? He has a right to buy the asset in future at a fixed price. So because he is having that particular right, he will typically pay a premium. To get that right, he is paying a premium upfront to the party who is giving the right, to the seller of the option. to the writer of the option, to the short position of the option, he is paying a premium upfront to get that particular right. So it can simply go like, okay, I'm buying a call option. Let's say Mr. X, he has bought or he has taken a long position in a call option. Let's say on a stock, saying that he'll be buying 100 shares of that particular stock after 1 month at, let's say, $100 per share. Now, if he wants, he can pay $100 and purchase it after 1 month, and if he is not interested, he can leave it off. So just to get that right, he is paying today, on the day he is entering into the contract, let's say $3 per share, he is paying as a premium. So today, by just paying a $3 per share, or probably overall $300, he is taking a right. If he wants, he can buy the share at $100 after 1 month, and if he doesn't want, he can just lose out his $300 and he can very well get out of the contract. So that is what we are talking of as a part of the call option here. By paying initially a $3 per share, the person who has taken a call option, he is purchasing the right to decide after 1 month whether he wants to buy the share at $100 or he does not want. So generally he will exercise the option only when the market price is greater than the 100. Here the $100 is what we call as the strike price or the exercise price. So when the market price is greater than the strike price only, he will be exercising it. So if the market price goes to 105 after 1 month, he has the option to buy it at 100. So he is going to buy it at 100, make a profit of 5 per share, means 500 for all the 100 shares. So that is the kind of a benefit he is going to get. But if the market price was 98 itself, there is no point in buying the share at 100. So he'll expire that options contract, and probably he may go ahead in terms of buying the share in the market at $98 itself. So generally when we talk about a call option, the exercising of the call option happens when the market price is above the strike price itself. Otherwise the option would be expired. And when the option is expired, the investor would be losing the complete premium. That is not a refundable kind of an amount. The whole premium is like an outright loss. So whatever is the gain that he is getting, the gain which he would be getting is the excess of market price above the strike price. If the market price goes below the strike price, probably he will expire it, means he is not getting any kind of a gain, he will not get any loss. The loss is only the premium. But if the market price is less than the strike price, he will expire the call option, which means his gain is zero. But if the market price is greater than the strike price, he will exercise the call option, means his gain is to the extent of the difference between the market price and the strike price. But in both the cases, the premium is lost, because the premium is paid on the day of entry into the contract, and premium is a non-refundable kind of a quantity. This is a kind of a payment that the long position is paying to the short position in order to take an option to either buy the share in future or not buy the share in future. Right? Now the same logic if I look at in terms of put option. Right? Just the same thing which we have discussed in case of call. So in this case, when I am talking about a put option, let's say X has purchased one put option, and this put option is giving a right to sell the share, sell one share at $100 on 1 month later at $100. Now for this, let's say the premium is $5 per share. So just by paying $5 today, the long position in the put option is taking a right that at the end of 1 month, if he wants to sell the share at $100, he will be selling it, otherwise he will not sell it. He can back out. He can literally get out of the contract. It's not a default, right? Because he has paid $5 per share to the short position to take the option that if he wants to go ahead, he will try to go ahead with it, otherwise he can expire it. So generally when I look at the profit that can come out for a person who has bought a call option, it can be like his maximum loss is limited. So probably if I put it in a kind of a graphical form, I see that the profit for a long call option is going to be something like this. If this is the strike price we are talking of, and this is the premium that he has paid, at the max a long call position can lose to the extent of premium itself, because when the market price, if I'm saying this is the market price, when the market price is below the strike price or the exercise price, he will not exercise the option. So because of that, he will lose only the premium portion. But if the market price is increasing above the stock price, he will definitely exercise the option, and the gap, market price minus the strike price, is what is going to be the gain. That gain is compensating some of the loss that is coming because of the premium. So that's where the break even point is coming only when the market price is somewhere here slightly above the strike price, and if the market price is going much above the strike price, there is a definite gain that is being made up by the party. The same case when we talk about the put. When we talk about the put option, the graph will look more like this, a long put. Because generally a long put option, the party who has got into a long put option position or a buying a put option, they expect that the share prices or the price of the asset is going to drop, whereas a long call position expects that the price is going to rise. So they try to protect themselves from a fall by taking a call option. But here the person who has got into a long put, he expects that the price is going to fall, but in case the price is rising, he wants to protect himself. That is where, if the strike price is this, as long as the strike price goes, as long as the market price goes lesser than this strike price, the benefit is to the extent of the difference between the strike price and the market price. But if the market price goes above the strike price, the person, why should I sell it at a fixed amount when I can sell it in the market at a higher price? There's no point in selling it at this strike price. So he is going to expire that contract. But if he is if the market price is going below the strike price, because of his right to sell, he can still sell that asset at this strike price itself. Though the market price is lesser than that, he can sell it to the party at this particular price. So the person who has got into the short position, he is mandated to buy it if this long put position wants to exercise this particular option, right? So this is how we typically look at the different profits which a long and long and shorts can make with respect to call options as well as put options. And what we generally see is, in some cases, even in case of American option, where there is a possibility of early exercise, there might be a possibility that a person who has got into the call option may not exercise it until the last day of the contract also, but he has different options to choose when he can exercise his particular option, right? And from the positions perspective, I have said we have already talked about a long position versus a short position, and corresponding to these two positions we generally create four different: long call, long put, short call, short put. I need to understand what is the payoff that is associated in each of these positions and what is the profit that is associated in each of these positions. When I say payoff, I do not include the premium, but when I am saying profit, the premium is included. That's the only difference between the two. So just as a part of the payoffs, if I want to denote long call, the payoff comes more like this. The payoff comes more like this. Whereas in case of short call, it comes exactly a mirror reflection to the long call. So this is a short call, means as long as the stock price is below something, there is no loss, but as long as the stock price crosses the strike price level, the long is going to gain, and when long is, that is when long is going to exercise the option, so definitely short is going to lose in that particular case. Similarly, when I am using long put, we talk about the graph being something like this, the payoff graph, and for the short put it is going to be exactly the mirror reflection of the same. But when we are bringing in the profits corresponding to the premiums that are being incurred, we are trying to bring up the mirror reflection slightly because the long is going to lose out on the premium, short is going to pay out on the premium. So you will find a graph which is slightly modified, but the overall shape of the graph looks more or less the same in case of long call, long put, short call, short put. And just in case of formulas, in terms of formulas, when I am looking at from a payoff dimension, if I have to talk of for a long call, the payoff is generally the maximum of the stock price on the maturity date minus the strike price, right? The market price on the maturity date minus the strike price, or zero, because zero means he cannot exercise the option. He is expiring the option, so he is not having any kind of a loss. So his profit is going to be either the difference between the stock price and the strike price, if it is positive, otherwise it's going to be negative. And whatever is the payoff of the call, long call, the payoff for the short call is exactly opposite to it. So that's where I call it as minus maximum of the stock price minus the strike price comma 0. Otherwise this can be written as minimum of strike price minus the stock price comma 0. So this could be the payoff for a short call option. Similarly, when I have to look out for a long put, I'll take it as maximum of the strike price minus the stock price comma 0, and in case of a short put, I take it as the minus of maximum of stock price minus the strike price minus the stock price comma 0, or this gets translated into minimum of stock price minus the strike price comma 0. This is what is going to be the payoff that is associated with the short put position, right? So this is the kind of understanding we need to have with respect to the option types and the option positions and the payoffs that are associated with the different forms of this position. Now, the next thing which I would like to discuss is what are the different kinds of assets on which these options are typically traded. The broad categories, of course, there are many ones, but initially I would like to talk about the options that are traded on stocks, the options that are available on foreign currencies. We have currency options, we have options on index which are heavily traded, and there are so many others also, but we have options on futures contracts as well. So generally these are majorly traded on exchanges itself. Some exchanges deal with American options, some of them with European options. But in case of foreign currency options, there's a huge volume in the OTC market, over the counter market, but even some of the exchanges are dealing with foreign currency options as well. Whereas in case of index based options, they are completely exchange based itself. Different exchanges are dealing with different exchanges are dealing with exchange based index based options, or even I see there's a lot of huge over the counter market also that is dealing with the index based options. To a large extent, I see that index based options are more European in nature, and to a large extent the settlement is more in the form of cash. It can't be any kind of a delivery of the index, so it is more and more with respect to cash itself, but the concept of call put, the all those underlying dimensions will still remain the same. But when we are talking about the options on the futures, it's going to be a more and more interesting kind of a concept, because here when I am talking about option on future, the buyer, the person who has taken a long call position, for him it is more of he has the right to typically choose whether he wants to take a long position in the futures contract at a future date, or he does not want to get into a futures contract. So whenever we are talking about a call option, from a long positions perspective, the intention is he should be able to take a long position in the futures contract, and probably a cash which is the difference between whatever the futures price on that particular date, expiry of the option. So it's basically like, today I have taken an option that I want to decide whether I want to enter into a futures contract or not on this date. So this date will be the option expiry date and the future starting date. Now I have frozen the futures price here itself. So what does that mean? If at all I am able to exercise this option on this day, it means I am ready to enter into the long position in the futures contract at the price that I have decided here. So what is typically coming up here is the settlement on this day is an option, is getting into the long futures position, and whatever is the difference between the futures price on this day and the futures price, as we have discussed here, the difference between the two is done on a cash settlement basis. The same logic when we are entering into a put option on the futures, it means it gives the right to typically enter into a short positions on the futures contract at a price that we have already decided here, but here we can enter into a short position in the futures contract, and whatever is the difference between the futures price minus the strike price, that would be done as a part of the cash settlement. So what we typically see is options literally can very well be constructed on any kind of assets, and they are going to they are going to give an option to one of the property one of the parties whether to exercise their right in future for buying or selling, or expire that particular contract. But to get that kind of an option, the party which wants to takes the option is paying a premium to the party which is giving that particular option, right? Now this is where an understanding of the basic concepts is very much required to progress further in terms of doing the calculations, getting into the valuation processes and all the various other mechanisms. Alright. Now the next thing which I can look at is the specifications that are associated with options. Few important points that come out with the options. One being the expiration date, generally set by the exchanges, and as we have discussed, even in case of futures, the expiration date generally is the month. Generally it is mentioned as January call option or something like that, so which means it is specified in terms of month. And typically what we see is different exchanges have different dates within that particular month. Some exchanges will prefer, let's say, the last Thursday of the month, or probably the third Saturday following, or the day following the third Friday or third Saturday. Some such kind of mechanisms would be provided by the different exchanges in with respect to the different kinds of options that they trade with. And the investor whosoever wants to exercise his option, there will be a cutoff time that would be given, where he can instruct the broker that he wants to exercise the option, and broker will complete the paperwork and the various formalities. He'll have another deadline that is associated with the same. So that kind of process is what follows with respect to the expiration dates. And when one option is reaching the expiration date, probably let's say the last Thursday of a particular month, and in this month, which is the July 2014, wherever the option the last Thursday has approached, this particular options for July 2014, they are all expired. So on that day, a new series of options for the next month, probably if I assume that generally the exchange is trading the July options, the August options, as well as the September options. The moment the July options reach the expiration date, then the October options can very well start off. So this is the way that typically the exchange initiates the new options kind of a process. Generally the options, majority of the stock options that we see which are traded on the exchange, they are hardly for a limited 3 months, 6 months kind of expirations itself. But in general there are longer term options also that are traded, probably in some of the exchanges, where the option maturities are even up to the extent of 3+ years also. Almost up to 39 months is what is the typical option maturity period, expiration period that goes for. Even those kind of options are also traded on the exchange. Then the next important specification that needs to be important for us is the strike price or the exercise price. Even this is something that is decided by the exchange itself. Generally it spaces based it generates a series of strike prices based on the current stock price at the beginning of the, let's say it is introducing July options. On that day when the July options are introduced, let's say the stock prices are somewhere in the range of 85 or $84 per share, then probably it may introduce options which are like $80 on the lower side, $85 somewhere closer, and $90. But during the period, let's say the stock price goes to 92 or something, then again probably a $95 option is also introduced. So like that, the exchange, depending on the underlying stock price during that period, the strike prices are continuously revised, and there is an adjustment that is done by the exchange for these strike prices to accommodate stock splits and stock dividends. Generally, the stock split is like one single share. One share is divided into more shares. Generally, when I say N for M kind of split, M shares are for every M shares which are existing, N shares are coming up now. So generally, it is expected that the stock price will fall by the extent of M by N. So currently, if the stock price is $100, and let's say the company has gone into a 2 for 3, 3 for 2 kind of a stock split, then it is expected that instead of 2 existing shares, they are replaced with 3 new shares. So there is nothing relating to the earning ability or the potential of growth for the company. It is just a corporate action. So what we see is the stock price generally becomes from 100, it becomes two-thirds of it, which means it will be somewhere around 67. So even the strike prices are adjusted by the exchange accordingly only in terms of the stock split, because it does not change the assets or the earning capability of the company. It's purely a corporate kind of an action. So what the exchange will do is, even the strike prices, it is simply adjusting them to reflect the expected change in the stock price. So which is nothing but the strike price. It is simply doing it as a multiplication by M by N, and the number of contracts earlier, when I have got into one contract, now it is equal to 1 into 3 by 2, 1.5 contracts. So the value is literally not changed. So it's as good as I have got into 1.5 contracts for strike price of $67 each. So that's the kind of equation that is being operated out by the exchange in case there is a stock split. The same is the logic that goes in when there is a stock dividend that is being declared by a company. Even a stock dividend is for every M existing shares, N new shares are being issued, right? Or probably so such kind of let's say for every 5 shares, one new share is being given. So what is typically looking like is 20% of the extra shares are coming into the company. So obviously, and without any kind of additional performance or without any kind of assets growing, only the number of shares have typically gone up, which means each share price is expected to fall to 5 by 6 of its existing value, because now it's as good as saying 6 shares in place of 5. So it's as good as a 5 by 6, 6 per 5 kind of a split, which means the share price is going to become 5/6 of the original price. So if the original price was $60 a share, and now one new share has been given for each of the 5 existing shares, it is expected that the share price is going to fall to $50 a share. So because the stock price is going to fall to 50, even the strike price is adjusted in the same way. The strike prices are also multiplied by 5 by 6 and adjusted accordingly. So as far as the stock dividends are concerned and stock splits are concerned, the exchange is going to adjust the strike prices in the same proportion as the stock split or the stock dividend has been declared. But if it is to the extent of regular dividends, the normal cash dividends that are declared by the companies, the dividend whatever has been declared in general, it reduces the share price of the company by that extent. Reduces the share price of the company by that extent. But what the exchange does is it does not adjust. One important point here, normally the exchange does not adjust the strike price or the exercise price corresponding to the cash dividend, because this number may not be significantly larger and it may not impact the share price quite drastically. So the exchange does not do any kind of modification to adjust the cash dividend, though it does some kind of adjustments for stock dividend and the stock split. Whereas some kind of over-the-counter exchange over-the-counter options which were there in the initial periods, they used to take care of modifying the strike price by the amount of dividend that was declared. So the strike price used to be subtracting the dividend that was declared and getting into an adjusted kind of a strike price. But generally, most of the exchange traded options, we don't see any kind of adjustments for the regular cash dividends that are declared. But in some cases, but definitely for stock dividend and the stock splits, where the impact is going to be significantly larger, the exchanges are playing a key role in terms of adjusting the strike price. And as we are seeing, there are different expiration dates for each option, for each stock. When I'm looking at the options that are available on the exchange, there are different expiration dates, and there are different strike prices, right, for different kinds of options. So a combination of these, probably if there are three different expiration dates at any point and five different strike prices, what we see is 15 call options would be trading for this particular security, and 15 different types of put options could be traded. And all these, let's say 15 call options for a particular security X are typically called as an option class. And within this option class, each of these 15 for a different strike price and a different expiration date, each one of them is actually called as option series. Option series is something like probably calling it as Infosys June 2600 call. This is an option series. Whereas Infosys uh, Infosys calls are called as option class, right? So this is how we differentiate option class and option series. Then one more important terminology that we need to be talking of is option wise we use three words: in the money, which is called as ITM. Any option strategy we use these words quite often. At the money, the option we say it is in the money, at the money, which is ATM, or out of money, which is OTM. Now what we are saying is, in case of call option, when the stock price is greater than strike price, we call it as in the money. Stock price, market price is less than the strike price, we call out of money. Stock price is more or less similar to the strike price, we call it as at the money. And it's the reverse in case of put. Stock is lesser than strike, stock is equal to strike, stock is greater than strike. What does this mean? Whenever we are talking about in the money, it means there is a greater chance that the option will be exercised. Whenever we are talking of in the money, higher probability of exercising the option. Whereas when I say out of money, there is a quite lesser probability to exercise the option and higher probability of expiring the option. That is where we call it as out of the money option. So that's the reason when the stock price is much lesser than the strike price, when the stock price is much lesser than the strike price, the chance that the option would the call option would be exercised is much lower, because there's no point in buying an underlying security at a price K when it is available for S, which is lesser than K itself. So there is a very strong chance that the option will not be exercised or it would be expired. That's the reason we call it as out of the money. But when I'm saying at the money kind of an option, there is an intermediate chance that the option could be either expired or exercised. So that is one way we define the different kinds of options with respect to their strike prices. So all the high strike prices that are associated with call option, we put them under OTM category. All the lower strike prices, we put them under in the money ITM category, and all of them which are closer to the current price, we put them under the at the money category for the option. So generally, when we are talking about in the money options, there is a high chance that they would be exercised on the expiration date, but out of the money options, there is a very rare chance that they get exercised. This is one kind of a terminology we need to be comfortable with. And another type of terminology which we need to be comfortable with is the word called intrinsic value of the option. When I use intrinsic value, it means that if I exercise the option today, if I exercise the option today, what is the value I'm going to get? What is the benefit that I'm going to get? That is what I call as exercise intrinsic value. See, if it is unfavorable, I will not exercise the option. So the maximum value, the minimum value for the intrinsic value, the minimum is going to be 0. Maximum is going to be the difference between the current stock price and the strike price in case of a call, or it is going to be the strike price minus the current stock price in case of a put, because we are talking about if at all the option is getting exercised immediately, what is going to be the value. If the value is negative, I will not exercise the option, means the value is going to be 0. Otherwise, I am going to exercise the option immediately, which is going to give me a benefit of either S minus K in case of a call option or K minus S in case of a put option. And if I am not exercising the option immediately and I am waiting until some time, this option is said to carry a time value. I am not exercising the option immediately, I am waiting for some time, which means the option is having a kind of a time value. So the total value of the option, which we always define as the intrinsic value, I can break down the total value of the option as intrinsic value plus the time value. And on the expiration date of the option, probably the time value is becoming 0. So whatever the value that is associated with it is going to be only the intrinsic value only. And even just like in case of futures trading, even in case of options, the exchange can very well specify the position limits as well as exercise limits. Whenever I'm talking about position limit, maximum number of option contracts, maximum number of option contracts that an investor can hold on one side of the market. One side of the market is under the assumption that the stock price will actually go down, or under the assumption that the stock price will actually go up. So that's the reason, under the assumption that the stock price will go up, the person can hold either the long call position or a short put position. So these two are actually grouped together because in these two cases, the investor is profitable when the stock price is going to go up. So he is taking a bullish view of the market there. But the other side is under the assumption that the market or the stock price will go down. So for that he can take either a long put position or a short call position. So from the purpose of computation of the position limits, we are looking at the number of options that a person can take on the one side view of the market, either on the positive side that the prices are expected to go up in future, or on the negative side under the expectation that the prices can go down in future. So the position limits are typically by clubbing these two securities into one group and these two categories of securities into the other group. But when it comes to the exercise limit, we are talking about number of contracts that can be exercised by one single individual in generally 5 consecutive business days. Number of contracts that can be exercised by one single individual or a group of individuals who are working together on 5 consecutive business days. So these are the main intention again behind all these kinds of limits is to prevent the market from getting unduly or heavily influenced by one single individual where he has taken a complete bullish view or a bearish view of the market. So the position limits are set from that perspective of no one single individual investor is trying to dominate the market significantly, right? So that's one thing, the various specifications that are associated with the option contracts. Now, when I try to just discuss on a brief way the trading associated, we see today majority of the derivative exchanges are fully electronic. So no physical meetings, and the majority of the exchanges, they go with the mechanism of market makers. So a market maker who is an individual, he typically goes with the bid side. There is a bid price that is being given for each option, and there is an offer price or an ask price that is being given. The bid is the price at which the market maker is willing to buy a particular option, the price at which the market maker is willing to sell a particular option. So whatever is the difference that is existing between the bid and offer is what we call as a spread, and sometimes even the exchange specifies some kind of upper limits with respect to the spread that can be offered. The exchange can very well specify the upper limit which can be specified. And the main reason again for getting into this kind of market makers is make sure if I want to buy, I don't need to really wait for a seller. So there is no time delay. The market maker acts as a seller immediately for me. So there is no need for waiting for a specific seller if I have to enter in as a buyer, and vice versa. So whatever is the price, without any kind of a time delay, we can very well execute the orders if at all the market maker is present, which means a liquidity is getting added to the system is because of the market makers. So that is one major advantage that is being showcased by the presence of market makers in the trading process. And just like the futures, we can get into an offsetting kind of a trade wherein the closing out of the existing position is happening. So when there is let's say a short when there is a short call that has been issued, probably an offsetting is for the same time period, same stock, same underlying, same time period, same strike price, we are going for a long call. This is more like closing out the position. So here the combination of the expiration date, the stock, the underlying asset, and even the strike price, all of the combination is what is getting executed as a part of the offsetting requirement. So if neither the long nor the short, they have offsetted their position, they have closed their existing position, so we say that the open interest is up by 1. But if the long has closed out his position but not the short, or short has closed out its position, not the long, then the open interest can still be at 1. But if long has offsetted its position, the short also has offsetted its position, then we say open interest is down by 1. Open interest is the number of long contracts which is equal to the number of short contracts which are outstanding. That is what is the way we define the open interest, and it will be up by 1 when both long as well as short positions are open and both of them are not yet closed, right? Then the next important concept that I am touch basing in this context is the commissions that are associated in case of options. Just like the futures, we talk about the orders wise, there could be a market order, there could be a limit order, which are more or less having a similar kind of definitions that are carried by the similar kind of definitions that are carried by the futures itself. But in terms of commissions, especially we see two different kinds of brokers. One is a discount broker and other one is a full service broker. The charge which is levied by discount brokers are generally lesser compared to a full service brokers. And generally in general terms we see some kind of fixed cost plus the proportion of the dollar amount of the trade. That's a typical way the commissions are being charged. And even if an option is getting into an offsetting position, the commission has to be paid again. If there is an exercise that is happening, the commission is more and more in line with the underlying stock purchase, which is higher compared to the typical derivatives trade. So even this kind of option incentive structure or the commission structure associated with the options, it looks like that favors more and more in terms of closing out the option positions rather than exercising them. When you are exercising them, the commission is more and more similar to that of the underlying securities, which is much higher. So there is a kind of benefit if the option position is closed rather than getting into an exercising of the option. And the other dimension that I look at in this context is the context of margins. In case of futures, what we have discussed is the long position as well as short position. Both of them have to deposit a margin with the exchange, and on a daily basis there is a mark to market settlement that is happening, and when the margin accounts balance is going lesser than a maintenance margin, then there is a margin call that comes up, wherein the party whose margin account has gone lesser has to replenish the margin account and supply more and more funds. And if those funds are not supplied, the position is closed by the broker. But here, in case of options, the long does not need to pay the margin. The reason is long has already paid the short. So there is no question of long defaulting, or there is no credit risk associated to the short because long will default. Long has already paid the premium to the short. So there is no risk from long to the short, but the reverse is very much existing. So there is a possibility that if long wants to exercise this option, the short may not be able to deliver it. So there could be a risk that is existing with the short position for the long, and that is the reason the margin is typically maintained only by the short position, but not with the long position when we are talking of the option. This is one more important concept that we need to understand from a overall perspective, right? Now, just before I conclude, I also look at a small variation with respect to various other instruments which are option like features that are introduced by the companies. There are instruments like warrants which are generally issued, let's say, by non-financial companies. Warrants on the company's stock, which gives a right for the typically they are packaged with a bond for the bond investors. So what typically the warrant suggests in that case is the warrants that are issued by the company on its own stock. It simply gives a right to the employees or to the bond investors that in the future they can purchase the shares of the company at a particular price which is decided today itself. So this could be a kind of alluring for the bond investors that today we are going to pay interest on the bond, but probably after a few years, if the company is performing very well, you can very well take the shares of the company in lieu of the bond. So that way it is more and more motivating, and probably it gives more incentive to the bond investors, more confidence to the bond investors that this company is really looking out for a outright growth in the future. That's one of the prime reasons it is proposing to give even the shares at a future date. Similarly, we have ESOPs, employee stock option plans. Generally, we look at them as call options. Even warrant is like a call option. ESOPs are a call option, and this is a kind of a motivating factor because even the ESOPs are talking of you have the right to purchase the shares of the company at a predetermined price after a certain point in time. So anyhow, as we have discussed earlier, the call option is more and more beneficial if the market price is greater than the strike price. The strike price at which the employee can purchase the option, the executive can purchase the stock, is already specified at the outset. So he will always try to work in the best interest of the shareholders. Even from his standpoint, his intention is to increase the share price drastically so that he can exercise the option buying the share at a much lesser price. So even that is a kind of an option like feature which is typically motivating the employees and which will contribute to the increase in the share price. Then we also talk about the instrument like convertible bonds, where a bond, the bond holder, the bond investor is having an option to convert, to surrender the bond or convert the bond into X number of shares. Each bond can get converted into an X number of shares of the company at a predetermined exchange ratio itself. So even in this case, initially he can invest in the bond, but if the company is performing very well at a later point, he has the option to take the shares of that company and get a benefit out of it. Even this is a kind of an instrument which is more and more an option like kind of a feature. And today's world even talks about real options, which are more and more to do with the investment decisions. We'll talk about these things slightly later. And the only difference between these kind of instruments and the options that are traded on the exchange, these kind of options, option like features, they are not traded on exchange. They are primarily working at the company layer, at the organization layer. The organization is issuing new shares in this case. Whereas when we are talking about call and put options that are traded on the exchange, it's just either cash settlement, or even if there is an exercise, the short is going to get the shares from the market and then deliver. So it's a readjustment of the existing shares from one party to the other party. But when we are talking of these kind of option specific features, if they are exercised, the company is issuing more and more shares for that particular strike price. So when these kind of option kind of features are exercised, the number of outstanding shares of the company is typically going up. Whereas when the typical call options and put options on the exchange or exercise, there is no increase in the number of shares. It's only the ownership that is getting involved, which means when we are talking about the call or put options on the exchange, it's more like a trading process. Whereas when we are talking of option exercise on these instruments which are issued directly by the companies, we are talking about like a new issue where new shares are getting introduced into the market. So the company's management is involved directly when we are talking of these kind of option like features, whereas the company's management is nowhere involved when we are talking of the options that are exercised or dealt on the exchange. Now, though we have seen that exchange is dealing very heavily in the option contract, we see even the over the counters market is very popular for options. Even today, there is a huge volume of foreign currency options, which is traded heavily in the OTC market. There is a huge volume of interest rate options, which is traded on the over the counter market. And today we hear about exotic options, which are non-traditional American or European options. They are not American or European. There are various other kinds of specifications where the characteristic of the option is changing, where the underlying structure of the option is more and more customized. We are calling them as exotic options. Even those kind of things are very heavily traded in the OTC market. But the major disadvantage that is associated with any OTC market is a risk of default, because there is no question of exchange intervening, there is no question of margins. So that is the reason, to minimize this to a large extent, even the over-the-counter market is stressing more and more on the need for posting collaterals. So this is what I wanted to cover as a part of the basic introduction to the option market, the mechanism in which the option market typically works. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.